Hi everyone, JJ here with the Art of Value. Welcome. Well, today we're going to look at Alibaba's latest earnings. Now, the stock's still down 70% from its late 2020 highs, which is a huge amount. Every time it gets a lift, it goes back down, so it hasn't been doing very well. Worries about the Chinese economy lately is the main thing that seems to be. But what's happening with the actual earnings? It's a return to growth, so let's dig in and see what's going on with the actual company. Now, the backdrop in China here is that they had pandemic restrictions for a long time and they came out of those, and Alibaba seems to have been helped by that, as well as the government not having such a hard crackdown or perceived crackdown on the tech companies in China. So we need to keep in mind that this is the first full quarter of results after the pandemic restrictions have lifted, so we can get a clear view of what's going on. And it does seem that Alibaba is returning to growth after those restrictions, and they have been in the meantime increasing profitability in the preceding quarters through cost cutting and more efficiency, and that seems to be making sense too. And they've been doing buybacks as well, so they've been doing good work in the meantime, and now they seem to be returning to growth. So Alibaba, as we know, is a huge company divided into business segments, and they're planning to spin off some of those segments in the coming quarters, the coming years, and I've made a previous episode about that. And some of those businesses are loss-making, some are hugely loss-making, and so a couple of segments make up for the vast majority of revenue and profit, but some of those have been cutting losses lately too, which has also helped the company. And in readiness for their spin-offs, they'll be hoping that those reach profitability and go on to do well. So Alibaba is a fairly complex company with many different business units. I'm going to try and simplify things to get to the core of what's going on with the business for this quarter. It's only one quarter. It's the long term that matters, but let's just see what exactly is going on by looking at some of the basic numbers. So looking at some of the overall financial results for the quarter, we can see that the consolidated revenue for the Alibaba group was up 14%, which is really great to see for investors, because previous quarters have been the growth is 0% or 2%, very low under those pandemic restrictions and the aftermath of that. But now we see 14%, which is really strong growth, returning to strong growth. It seems like we'll have to see what happens in next quarters if it continues, but this is a really good sign that things are on the up and up here, even as the Chinese economy doesn't look so good from the outside anyway. Now, income from operations was up 70%, which seems amazing, but they have these one-off events, these one-off adjustments that skew this figure, so we can pretty much ignore that for this quarter, again, as we have for some other quarters, because it's not accurate, it's not normalized, so we can put that to one side. They had significant stock-based compensation reversal that inflated that number hugely. It would have been much lower other than that, but we can look at some of the other figures to get a clearer idea of what's going on. Certainly that revenue figure of 14% is encouraging, but what else is there? So if we look at their cost structure, their costs have been coming down. They're getting more efficient as a huge company, which a lot of companies have at this time, been focusing on efficiency. US companies have been doing that too to try and prepare for a possible recession coming, and it's no different with Alibaba. While their share price has been going down, they've been trying to become more profitable, more efficient. Costs have been either flat or down. If we look at some of these numbers in terms of costs, we see that cost of revenue as a percentage of revenue was down from 62 to 61%, and sales and marketing as a percentage of revenue was flat at 12, so flat, not down, and product development was down from 5% to 4%, and general and administrative was flat at 4%. So it's not as big as some of the cost savings that we've seen in previous quarters, but still pretty good, either flat or slightly down, which means that they are becoming more efficient as a company, and that's a good sign if you're an investor that their costs haven't been blowing out at this time. And one of the important things to look for, of course, is cash flow. What are they doing with their cash flow as well? How much cash flow do they have? Are they allocating it in the right way? Investors like Warren Buffett look at this, of course. Are they being sensible with it? For investors, are they being investor friendly here, or are they just throwing money away by buying shares expensively? Now, Alibaba's cash flow does tend to fluctuate from quarter to quarter, being largely retail based, or that's where a lot of their revenue and profit comes from, retail based e-commerce, of course. But we can see for the quarter, it was 45.3 billion RMB operating cash flow, and that's about 6.2 billion US dollars, which was up 34% year over year, which is a pretty great increase from the year before in operating cash flow. And free cash flow was 39.1 RMB or $5.4 billion, which was up 76% from the year before. So that's pretty great increase from the year before. So that really positive cash flow situation was a result of their business operations, better business operations, more cash being produced, and also lower capital expenditure. So the combination of those two things made that really great result for the quarter. So $3.1 billion worth of cash flow was used to repurchase shares during this quarter. They've had a repurchase program, which is really not surprising during this time when the shares are down 60 to 70%. This is something that investors do like to see when the share price is down like this. Rather than buying expensively, we have seen examples, you do see examples of companies buying when the share price is pretty high. And from my point of view, it's a bit of a red flag when you see management buying back shares at expensive prices, way above intrinsic value. Warren Buffett and Charlie Munger would never do that with Berkshire Hathaway, for instance. They just buy at a certain level below what they think is intrinsic value. So when management is buying back at expensive prices, that's a red flag in terms of capital allocation. They're kind of just flushing money down the toilet at that point, rather than putting the cash to good use somewhere else, reinvesting it rather than buying back their own shares expensively. However, it has to be said that Alibaba does engage in stock-based compensation as well. So they're buying back shares, but they're also issuing shares to management and employees. But on balance, they're actually repurchasing more than they're giving out. So it's just marginal for this quarter, but over the last year or so, it's been a few percent that they've been buying back. So they're not hugely buying back and it's eating up those shares while it's cheap. They're issuing some and buying back some, but on balance, it's gone down a little bit, which is good to see as a shareholder in general. You see that some US companies, some US tech companies issue huge amounts of shares. Stock-based compensation is just absolutely huge, and so it's pretty disappointing to see as a shareholder when you see that you're being diluted a lot. So the average share price that they've been buying back is about $87, which is a lot less than it was, say, at the end of 2020 and pretty much anywhere from there until now. So if you think that Alibaba is undervalued, then they've been buying back at pretty good prices. That's actually lower than the price than it is now, which is about $89 as I speak. We're going to look briefly at the individual business segments in Alibaba. As I said, they're going to be splitting these off into separate companies. I've talked about that in previous episodes where they announced it and went through the different segments. So go and see that if you haven't. I'll put a link in the description. And also the previous results, you could have a look at that if you haven't as well. So first we're going to have a look at the Taobao and Tmall group, which provides the most revenue, perhaps the most important, the biggest sector for Alibaba, and it provides 49% of revenue this last quarter, which is pretty amazing when you think about it. Such a big company, such a lot going on, so there's a lot of focus on this segment. It really matters what's going on with this segment. This segment used to be called the China Commerce segment, which gives you an indication of how big it is, all that focus on the huge China market, and this business subsidizes their loss making. It has in history to make them profitable in the future, and some of them are getting towards that, which is good to see, but that's why this segment is so important, because it's been subsidizing those loss making, helping them grow and providing a lot of revenue and profit. So this segment reported revenue growth, which is encouraging to see for shareholders that it's back to growth, because the last few quarters have been pretty much zero growth at all, not much to speak of. So it's a return to those double-digit growths for this segment, this powerful, strong, huge behemoth sector. So it's good to see from that point of view. That's obviously to do with the buying power in China, the consumption, the government's trying to be encouraging for consumption, people buying things online, buying more things, especially as the economy doesn't look so good. And that seems to be working, at least for this quarter. We'll see what happens next quarter, but pretty positive in strong double digits, the growth there. Next, we have the International Digital Commerce Group, which made up 9% of revenue in the quarter, as opposed to that 49%, remember, in the previous one. So a lot smaller, and it is loss-making as well, but it's growing fast, and it's actually not too far away from profitability. So that's also a pretty encouraging sign from shareholders. This international segment includes Alibaba.com, AliExpress, Lazada, and Trendyol. And as I said, it's been one of the fastest growing segments in the past few quarters. Revenue in this quarter was up strongly 40%, and that was almost entirely due to international retail, which was up 60%. So really growing strongly internationally outside of China. Next, we have Local Services Group, which is only 6% of revenue, smaller again, and it's very loss-making at this point. This segment includes Alma and AMAP, and revenue for this quarter was up 30%, so even though loss-making, strongly up in terms of revenue. EBITDA margin was minus 14% as opposed to minus 25% for the previous quarter, but getting better as it grows and tries to reach profitability over time. So next is Cainiao Smart Logistics, slightly bigger at 10% of revenue for the quarter and just becoming profitable. Revenue was up 34% for this segment, so that's pretty strong growth again, reflecting a lot of the goods moving around because it supplies fulfillment and logistics for Alibaba's businesses and for businesses outside Alibaba as well, increasingly. EBITDA margin was positive 4% as opposed to negative 1% for the same quarter last year, so profitable on that basis, and maybe more so as the quarters go forward. They do tend to fluctuate, as I said, for Alibaba as a business, but you'd have to think that if things go well, this could be more and more profitable as time goes by. Next is the much talked about focused on cloud segment, which represents 11% of revenue and about 1% of overall profitability. It's been pretty disappointing in the last few quarters where they haven't been growing after huge growth in previous years, and there are questions about why that is and if it can get back to the huge growth that it had. If you look at Amazon's sector, similar to cloud segment, and the US companies, they've had a lot of growth, and can Alibaba do this? So revenue growth of 4% and EBITDA margin of 1.5%, which isn't very much, a lot of work to do there. Can they get back to the strong growth that they had? And like US companies have, there's definitely a lot of scope to grow in this area, but China's kind of a different animal than the US is in terms of this. If this segment returns to strong growth, and it's going to spin off into its own company as well, so there'll be a lot of focus on this segment, on this company to grow from there. Can they do it? Can it return to double digit, even 20-30, as some other companies in the cloud sector have? That would definitely be a strong sign. Next, we have the digital media and entertainment segment, which only represents about 2% of overall revenue, and it's just reaching profitability as well. This segment involves Alibaba Pictures and Youku, a kind of Chinese YouTube, and revenue was up 36% year on year. So again, strongly growing there, and profitability getting better as well. So this is another good sign for the future in this segment. There's a lot of segments that seem to be in this position of slightly better, improving revenue and heading towards profitability or becoming profitable. So good signs here again. Now the margin was only 1%, but that's up from negative 23%. So definitely getting better in this segment. So next we have all other segments, which, as the name implies, includes everything else that we haven't talked about, including Alibaba Health and Fresh Hippo, and it represents 19% of the overall revenue, which is quite a lot, really. Revenue was only up 1% for this segment, and EBITDA margin was up to -3 from -5, so a slight improvement there. So after going through this segment, some definite positive signs there of increased profitability and or less loss-making, greater revenue growth. So overall, some good signs there if they can keep that up in the coming quarters. There are questions over the Chinese economy as well. There always seem to be in the last few years, going through the pandemic and then coming out of it. The property sector's in question. How will that affect the economy? Companies like Alibaba going forward, we'll have to see what happens, but definitely some good signs there for this quarter. Some growth and more profitability there. And overall, Alibaba's still producing a lot of cash. They've got a lot of cash which they're putting towards share buybacks when the share price is down 60-70%. So if they can keep continuing to increase cash, which is as a percentage of their overall market cap is pretty high. They're in a very good cash position. So the share price is going down, but the business itself, as we have seen, is pretty good and getting stronger as these quarters have gone by. I think a lot of people have sort of written off Alibaba, but if we look at the actual business, it's doing pretty well and starting to do better. So we'll have to see what happens with Alibaba in the coming months and years. It seems to be a long wait for shareholders who have been in it at a much higher price. Will it pay off in time? It's a mega cap company. Can it get back to where it was before? It's gone a long way down. It's got a long way to get up there, and we'll see what happens in the coming months. It's going to be interesting to see in the next quarter if they can keep up this profitability, this growth, return to growth. Can they sustain it? Let's wait and see. Now, if you're watching on YouTube, I'm going to put a video up here or in the description if you're watching or listening elsewhere to that episode I made about the breakup of Alibaba, what they're planning to do, their breakup plans into those 6 business units, why are they doing it, and when are they going to be IPOing those business units. So go and watch that if you haven't already. And thanks for watching or listening this time, and I'll see you in the next one.